Okay, so you're welcome once to this class. This is yours, Samuel Ibanda, your tutor. And today we want to look at the cash flow statement, okay? Or what we can call the statement of cash flows. Now, why the statement of cash flows is very important is because just as we looked at the rest of the statements, the statement of financial position, the statement of P&L, or what some other people may call statement of comprehensive income. We also looked at the statement of changes in equity. We also need to understand how a statement of cash flows looks like, okay? Yeah, so like earlier indicated, you may not see this directly on the syllabus, but it's one of the things that we need to know, okay? Because at the end of the day, one of the things that is highlighted, especially within our learning objectives for this paper, is to be able to understand the respective financial statements, how to prepare the respective financial statements, okay? So that is very important. So as we can see here, the objective, of course, this statement of cash flows is also governed by a standard called IS7. Okay, it is it's basically IS7 that gives us guidance on what to exactly do when it comes to the statement of cash flows. Okay, now why would we draw up the statement of cash flows is because the rest of the other statements do not give us some kind of information. Now, the statement of financial position, of course, gives us basically what is our position in terms of assets, liabilities, and then equity at the end of the year, okay? The P&L gives us information about the movement of, okay, like in terms of profit or loss. That's what the P&L does, the statement of comprehensive income. Now, there's none of those two, or the statement of changes in equity also gives us what is how our respective different equity items have changed over time and what are their closing balances. Now, the statement of cash flows helps us to give us information about how the company has generated cash during the time of the period and how it has been able to utilize that cash in terms of cash flow and cash inflow and cash outflows, okay? So that is what the statement of cash flow basically helps us with. So with that in mind, knowing what cash flow helps us, it's very good that we also understand what could be some of the basic benefits. Now, the cash flow is also prepared at the end of the year, okay? And in preparing, as we shall proceed to see, when we are preparing a cash flow, we basically use what? We use the statement of financial position and the statement of profit and loss, okay? So we shall see how that comes into play, okay? Yeah. So these are the benefits of the cash flow information. You shall be able to understand more, but yours is to know that the cash flow statement, since it is recording more of cash, okay, it basically helps us also to look at how the different net assets have changed, okay? By net assets, we are trying to look at, especially when it comes to our long-term assets, how they have changed over time and how does that affect our cash flows? Because you know that in purchasing these assets, we basically incur what? We basically use cash, okay? So we're able to reflect on how everything has changed over time within the period of 1 year, and then also giving us a picture of how that affects the amount and timings of cash flows, okay? The statement of cash flow, of course, also helps us in assessing the ability of our entity in generating cash and cash equivalents, okay? As you can see, we have two terms here, cash and cash equivalents. Now, cash is directly the cash that you know, okay? But cash equivalents, just so you know, right here, cash equivalents are basically short-term, they are short-term, high liquid investments short-term high liquid investments that are readily convertible to known amounts of cash and which are subject to an insignificant risk of change in the value, okay? Now, some of the cash equivalents could be, let's say, maybe like check. A check could be a cash equivalent, okay? You could also have things like treasury bills. A treasury bill is also a cash equivalent because it has less insignificant risk of change in value, okay? Because this is a government instrument, and once they have told this is the interest you get, that will be the same interest that you get. So we have several of them, as we shall see moving forward, okay? But cash itself, every time you hear cash, it's basically cash on hand and then demand deposits. Cash on hand is what basically holding on hand. When we say demand deposit, we mean that amount of money that just moved to the bank. Okay, is what basically happens. June. Somebody's microphone. Guys, let's make sure that we mute our microphones so we don't disorganize the class, okay? Yeah, so that is what I wanted to explain when it comes to cash. So demand deposit means that money can actually be gotten from the bank at any point in time, okay? So that is what happens with that. So basically, statement of cash flows, like we said, it is helpful in helping us assess the ability of the entity to generate cash and those cash equivalents, and then compare the present value of the future cash flows of different entities, okay? Just in case maybe we have different subsidiaries or we have different branches and so on, okay? And then it also enhances comparability of reporting of the operating performance, okay? Remember, the statement of financial position and the statement of comprehensive income, they have a lot of to do with, let's say, some elements of accounting treatments, okay, for different transactions and events. And sometimes we may not, they take into consideration what we call the non-cash items, things like provision, things like depreciation, all those are non-cash items. Now, when it comes to the cash flow comes out to eliminate those to give us a true movement of our cash. I think you've had cases where somebody says a company has made a profit of let's say 30 million, but when in reality the 30 million is not in the bank account, okay? Now, it is the cash flow statement that is able to give us a reconciliation to tell us that, yes, in the bank account we have, let's say, 3 million, and then the P&L shows that we have 30 million. This is why it is actually like this, okay? So the cash flow statement is able to give us that kind of picture, okay? And then, of course, it helps us in assessing the actualness of past assessments of future cash flows. Basically, we can also use the statement of cash flows to determine how likely our cash flows will be within the organization, okay? Now, when we are drawing up our cash flow, okay, we basically divide it in terms of what we call 3 sections, okay? We basically divide our cash flow within 3 sections. And just like the way you have assets, liabilities, and equity, when it comes to cash flows, we have basically what we call operating activities. Then we have what we call investing activities. Then we have what we call financing activities, okay? And by operating activities, basically, these are, in simple sense, these are basically revenue producing activities. They could include things like maybe normal sale of goods and services, payments of suppliers, let's say payment for salaries and so on. Basically, that is happens when it comes to the operating, the day-to-day normal running of the business, okay? And then we have what we call the investing activities, okay? We have the investing activities. Now, the investing activities are basically those activities that the company does that include the acquisition and disposal of long-term assets, okay? And other investments which may not be included within your cash equivalents, okay? I think you saw we say that one of the investments like treasury bills could be included within the cash equivalent. So we look here at other investments, could be, let's say, acquisition of and disposal of long-term assets. You could have other investments like maybe investment in another company, okay? You can have like an investment in another company. And then we have the last section, which is called the financing activities, okay? We have what we call the financing activities. And financing activities, these are basically activities that are to do with either contributing equity or borrowing, okay? Now, as from just the word, just like the way we had operating was the debt for the day-to-day, and that is basically the principal revenue producing activities, the buying and selling, buying of raw materials and then selling of the finished goods, okay? That is what exactly happens. And then for investing, we are saying this is to do with, you know, every time you buy a new asset, just like an individual in your life, when you buy a new asset, it's like an investment, okay? But for business, we believe that these assets will definitely do they will bring in some amount of money. And this amount of money could be, of course, in terms of what exactly we are going to use these assets for, okay? So that is the kind of return that gets off these assets. In the same way, the investing activity is not only limited at the purchase of or acquisition of long-term assets, but it also includes the disposal of some of these assets, okay? So it's important for us to appreciate that. And then, of course, other investments that are not included in the cash equivalent. So that is investing. Now, financing, from just the word financing, basically looks around money coming in to finance the business, okay? And this could be in form of equity, but could also be form of borrowing, like long-term borrowing. When you borrow, let's say a loan from the bank, it's a financing activity, okay? So when we are preparing the cash flow statement, it assumes that business actually does activities that are grouped under those respective categories: the operating activity, the investing activity, and the financing activity, okay? So it's important that you get to understand. Now, when we look at the presentation of the cash flow, you're going to appreciate something, okay? Yeah, very much. So the statement of cash flows, of course, presents cash flows during the period that are classified under respective categories: the operating, investing, and financing activities, okay? Now, cash flows from investing activities, just like the way I've been trying to give you some of them, okay? Now, we have, as you can see, we have the making and collecting of loans, the acquiring and disposing of debt or equity instruments. And we could also have property, plant and equipment, and other productive assets that are held in production. When it comes to cash flows from investing activities, okay, these are cash inflows, the others are cash outflows, okay? Now, cash inflows here would be, for example, receipts from collection of loans by the enterprise or sale of entire entities' debt instruments, okay? We could also have receipts from sale of equity instruments of other enterprises and from returns of investment in those instruments. Now, when it comes to investing, we are basically looking at another entity, okay? We are basically looking at another entity. For example, if we give a loan to another entity, it means like it's an investing activity, okay? If, for example, we invest in another entity, it's an investing activity, okay? That's what they are trying to include here. And then, of course, the other that is also very common is the receipt of sale of property, the receipts from sale of property, plant and equipment. When we dispose of the assets, that receipt is regarded as a cash inflow from investing activity, okay? So we also have what we call cash flows for the cash outflows for investing activities, okay? So this could be disbursement of loan, made by the enterprise and payments to acquire debt instruments. We could also have payments to acquire equity instruments of other entity. Okay, this is only about investing. We could also have cases where we have payments at the purchase of a fixed asset. Okay, you're going to appreciate this when we look at how the format looks like. Okay, so let me just give you a glimpse of how that will reflect in the format. So this is the format that we are trying to go through. Okay, and as you can see, this is a format of the cash flow. So we have the operating activities. Okay, and as you can see, if this is operating activities, basically we say that operating activities are looking at activities they are called revenue producing activities. They are basically the day-to-day activities of the business. Okay, so as you can see, we usually start with the profit before tax. Okay, we usually start with the profit before tax, and then we usually make adjustments. Now the adjustments we make are usually for those things that are for first are the non-cash items. Now you're going to see something here. I earlier indicated that when we are preparing our cash flow, we actually use what? We use the statement of profit and loss, which is your statement of comprehensive income, but also use what we call the balance sheet, okay, which is your statement of financial position. Now, we've also appreciated that when we are drawing up our cash flow statement, we have key headings. We have this heading, cash flows from operating activities. Then we have cash flow from investing activities. Okay, and then we have the last, which is cash flow from financing activities. Okay, that is what I want to first take into consideration before we can proceed. Now, yours is to understand what exactly is under each of these. Okay, so that when you have information, you can easily know what I'll include in what. Okay, now remember we are saying that we start with our profit before tax. Now, the reason why we bring our profit before tax here, like I said, the P&L does not give us the true cash position of the company. By a company saying I've made a profit of 3 million or 4 million or 30 million, does not mean that they actually have that money on their bank account. Okay, so the cash flow statement is one that makes the adjustments on that profit to be able to give us what we call our cash balance. Okay, which is the closing cash balance here that we derive to. So it's basically making a reconciliation between the profit you have and what you have on the bank account. Okay, which is usually the last figure that we have there. So in this case, what this would mean is that right here, we start with our profit before tax, which we're able to record there. And then we are able to make adjustments. Now, the first adjustment we are making is for depreciation. Now, why we make the adjustment for depreciation, as you can see here, is because depreciation is a non-cash item. Okay, by non-cash item, I mean there is no cash transfer that happens when we are depreciating assets. It's basically an accounting treatment. Okay, we don't pay for depreciation. Okay, it's basically an accounting treatment to recognize it as an expense. So because our profit already has depreciation deducted from it, okay, we have to use the cash flow statement to add it back. Remember, we are trying to make a reconciliation between our profit and what we have on the bank account. Okay, so we have to add back the depreciation because remember we subtracted it to come to this profit. Okay, so that is why we first add it back to determine what would have been our profit without this so-called depreciation, which depreciation we are calling a non-cash item. Okay, which does not have any effect on cash movement, because when you depreciate your assets, there's nothing like maybe cash is moving out. Okay, yeah, so that is the first thing that we also do. Okay, so we are able to add back the depreciation. Now, we also have this so-called gain or loss on sale of assets, okay? Now, we know very well that a gain or loss on sale of fixed assets, this is the same thing as gain or loss on disposal, okay? If you remember when we are drawing up our disposal account, you'll be able to appreciate that a gain is actually an income, okay? A gain is a gain on the sale of the asset is like an income that is added to the P&L incomes, okay? And a loss is done what? A loss is basically deducted, okay? Is included within your expenses. Now, when you're making an adjustment onto your profit here, okay? Because the gain had been included in what? The gain had been included in within your incomes, okay? We have to basically go ahead to remove this off from our assets, okay? We shall definitely remove it because the gain and loss, this is also just arbitrary. This is an accounting treatment as well, okay? There is no cash movement that really comes from a gain or loss on sale of fixed assets. So we basically remove this. The same thing with the loss as well. So we're able to make respective adjustments. The same thing also happens with the increase or decrease in provision for doubtful debts, okay? The increase or decrease in doubtful debts. Now, remember what we said with the increase in doubtful debts? Increase in doubtful debts is done what? Increase in doubtful debts is added to our expenses, but a decrease in provision for doubtful debts is done what? Is actually added as an additional income, if you remember how to treat provisions, okay? So in this case, what we are saying basically is we have to do what? We have to come and make the adjustment, okay? So whatever you had added onto your profit, okay, is actually deducted. And whatever you had subtracted to come to your profit, or whatever you had included in your expense is supposed to be added back, okay? So that is the key principle. So you know. The same thing when it comes to amortization of government grant. This one in the same way, this is also, this is like depreciation. This is also just an accounting treatment. So you'd also make an adjustment when it comes to this one. The same thing also when it comes to things like deferred cost, okay? This would also be made as an adjustment and so on. Now, once you're able to do that, in the same way also in the interest expense as well, we also have to make an adjustment. In most cases, this interest has not yet been paid, okay? But because we are calculating our profit, this interest is actually done what is deducted. So when we are making the adjustment, we have to actually add it back, okay? The same thing with, let's say, increase or decrease in provision for warranties, okay? Just in case we have warranties, warranties is basically when you sell a product to one of your customers and then maybe give them a warranty, okay? I think you know, you might be knowing more of guarantees, but guarantee and warranties are of a similar nature, okay? So all those, you just make a provision for that warranty because you've not provided it yet. So it's just an accounting treatment, okay? So that is something that you may need to pick so much there. And then when it comes to, after you've done that, okay, you get what you call the operating profit before working capital changes, okay? The operating profit before working capital changes. Now, you also have to make adjustments of the working capital changes. Now, this is operating profit before working capital changes. Now, the reason why we now go ahead to also have adjustments for working capital changes is because we have what we call the working capital. When somebody says working capital, what they're trying to mean, especially in business, they're trying to mean the difference between your current assets and current liabilities, okay? When someone says current working capital, in accounting, they're basically meaning the difference between your current assets and current liabilities. Now, when we are drawing up our cash flow statement, we also need to make sure that we are adjusting for the working capital changes. And the reason why we make this adjustment is because for whatever has happened within the current assets and the current liabilities has an effect to cash, okay? Has an effect to cash. And what I mean by that is that if, for example, your current assets have increased, okay? It means that maybe you've actually used money to increase those assets, okay? So we are going to see, as we see here, for example, one of the current assets we have is inventory. Now, your inventory can either increase or decrease. And by this, I mean you're trying to compare your opening inventory and closing inventory, okay? So when your inventory increases, when you compare your opening inventory and closing inventory, and it has, let's say it has increased, it means that in between there, you actually had what? You had to actually buy more inventory, okay, to come to an increment. So that is why we're seeing that we have to, if for example, it's an increase in inventory, it means that there is actually a deduction, like it is a cash outflow, okay? When inventory increases means that we actually bought more inventory, or we actually did an activity that brought about increase in more inventory. So it's like a cash outflow. In case inventory decreases, when you compare your opening inventory with the closing inventory and inventory has decreased, it means you sold inventory to actually earn what? To actually earn cash, okay? So that will be a cash outflow, okay? So I hope you can relate some of this. It's the same thing with debtors. Now, let's look at increase in debtors. When your debtors increase, okay? When your debtors increase, it means that you actually got more money, okay? In reality, in terms of cash flow, we reflect this as more money has flown, has come to the company, okay? And then, okay, maybe just to explain, what are debtors? Debtors are like your accounts receivables, okay? And these are people you've sold to, okay? These are people you've sold to. So we have two cases. We have a case where our debtors, the one we started with, are higher compared to what we are ending with, okay? If our debtors are higher, our opening debtors are higher compared to what we ended with, the whole assumption is during the period we have actually received some money from these debtors, okay? So in that case, that will be like a cash inflow, okay? So I hope you pick the principle. And the same thing also would happen when it comes to our debtors. If we started with, let's say, a few debtors, and then we ended with let's say more debtors, okay? So that is a reflection of more of a cash outflow. It's like we have more people that we demand than what we started with. So it's like more money actually got out of the company, okay? You'll appreciate this even as we try to look at one of the questions, okay? How we would play with these things. Similar to prepayments, same principle, okay? And then we also look at the increase or decrease in current liabilities. Now, liabilities also have an effect on cash, okay? And if we are looking at creditors, who are also your accounts payable, when your creditors increase, okay? When your creditors increase, it means that you actually got more money from your creditors, okay? Your creditors gave you more money because creditors are people who demand you. So it means that you got more money during the period. So if I'm comparing my beginning creditors, okay, with the closing creditors, then I know that actually money came through. Now, reason why I'm bringing in comparisons here, and you're going to see it as we proceed, that when a question comes for cash flow statement, okay, and I just want to run away to give you a picture because I want to make sure that what I'm explaining, you can actually get it, okay? So this is what we have, okay? This is how the question definite usually looks like. So we have our 2016 and then our 2015. In most cases, when you're doing a question on cash flow statement, they will bring you financial statements of 2 years, okay? They'll bring you financial statements of 2 years. So like the way we are seeing, we have 2016 and 2015, okay? Now, as you can see, they go ahead to give us a turnover. This is like a statement of profit and loss. So they give you a turnover, cost of sale, they even give you gross profit, and then they also give you total income here. Then they also have what we call profit for the year, okay? Now, like we said, when we are starting our cash flows from operating activities, we start with a profit for the year. So this is where you would pick your profit for the year that you actually need to include where? Need to include here. You see this profit before tax that you start with is what you do. Now, if you're preparing a cash flow statement for 2016, you definitely take the profit of 2016, okay? But remember, they told us that we start with the one of profit before tax, so you actually use the 122,250 to start, okay? Now, what I want to demonstrate when it comes to the changes in working capital. So I believe you've appreciated that when I speak about working capital, I'm actually speaking about what? I'm speaking about current assets and I'm speaking about current liabilities. So this is 2016, okay? This is 2016 and then this is 2015, okay? So once I say changes in working capital, when I say changes in working capital, what I'm trying to basically mean is this was the inventory you started with. Okay, this is what you started with. You started with 96,000, okay? Because at the end of, if this is a statement of financial position for 2015, it means that whatever you see here was the closing balance on 2015, but it was also the opening balance for 2016, okay? So if this inventory was the balance for 2015, it means that it was also the same balance that actually became the beginning balance for 2016. So basically, this is the same thing as the beginning balance of 2016 and then the closing balance of 2016. So when I say working capital has changed, I'm basically saying that my inventory I started with was 96 and now it stands to 184,500. And what I was trying to mean by saying that if my inventory increases, like I now have 184,500 and then I started with 96, it means that I actually used more money to bring in this inventory, okay? Just from layman's understanding, I used more money to bring in more inventory, okay? So it means that it is a cash outflow. So if I'm able to get the difference between 184,500 and 96,000, I should be able to record this as a cash outflow, okay? Because my inventory increased, so it means that either I paid more money to my suppliers to get more of this inventory to increase, okay? So that is the key principle. And the same thing also happens with your receivables here. As you can see, we started with what? We started with 264,750. And then we have what? We have 34,500. So in this case, it means that we actually did what? We actually have more receivables at the end of the year. So this would mean that we sold more on credit during the period to come to this, okay? So in layman's language, just like I said, if these receivables were 264,750 and we had only maybe 150 here, it would mean that during the year, more people that we had sold onto credit actually paid us during the year, okay? And that would be a cash inflow, okay? That would be a cash inflow. But if trade receivables, the people that we demand, okay, are increasing, it means that more money actually just went out through the sale of these assets through the sale of the products to our customers, okay? So in this case, this will be actually more of a cash outflow, okay? Just like the way we had for what? For our inventory. So in most cases, when our current assets are increasing, it means that it is a cash outflow, okay? So I'll be able to get the 264,750, subtract it from 35, and we'll be able to record this as a cash outflow, okay? So that is important. And the reverse would also be the same. Just in case 345 was here, and 264 was here, it means that I would record that as a cash inflow. So it means that I started with 5,000 and I'm now ending with 264,750. Okay. Now the same thing also. Okay, now cash is not looked at this level. When we are looking at changes in working capital, we first leave out cash. Remember, what we are trying to do is to balance between cash and our profit. So cash is not brought at this level. Okay, so that is what exactly I'm having here. Okay, that is what exactly I'm having in my format here. After I've made these respective adjustments, okay, depending on the question, I have the adjustments for working capital changes, okay? And as you can see, either increase or decrease in current assets. Like I said, you will always have information for 2 periods to enable you to find either an increase or decrease, either decrease or increase, whatever you might have, okay? For all the assets. As you can see, we are not bringing cash at this level, okay? Cash is what we are deriving to, and cash will appear as your last, okay? This is what you're trying to aim at, okay? This is your closing cash and cash equivalents. This is what you're trying to aim to get to, okay? So it's important that you pick the understanding of that. So that is what happens with working capital, and the same thing you'd also do for your liabilities, okay? When you're trying to get the changes in liabilities, let me just try to check and see how our liabilities here will look like. So as you can see, remember we're looking at the current liabilities, okay? So these are the current liabilities that we have. Now right here, we basically look at we look at the trade payables, okay? Because taxation and interest is handled differently. We look at the trade payables. So as you can see, we had 235, 233, 250 at the start of the year, okay? And then we ended with what? We ended with 183. So it means that the people that demand us that we started with are way lower compared, are way higher compared to what we ended with. So it means that we actually paid more money during the period to drive our balance from 233 to 183, okay? So that difference is basically coming in as basically a reduction, okay? Which reduction is a cash outflow, okay? For us to achieve this is a cash outflow. So you're able to put that as more of a positive, okay? So that is what I wanted to stress when I'm trying to give you that background. So that is what we basically do when we come here, okay? And then we're able to come to our interest paid and taxes paid. So like I said, if the examiner gives you this information, they will always give you these two things. They always give you the taxation and interest, okay? They always give you the taxation and interest. Now, the taxation and interest is looked at this level. As you can see, after you've done your working capital changes, we actually get what is called cash generated from operations, okay? We get what is called cash generated from operations. Now, after that, we do less interest paid and taxes paid. Now, one of the things that I want you to know, and I think we've done something very similar like this when we're trying to look at one of the questions, okay, is if something is called, if this is your, now this is our balance sheet, and once you see this in your balance sheet, taxation and interest, and sit under your current liabilities, it means that these ones are basically outstanding obligations, okay? Just from the perspective of reading your balance sheet or statement of financial position, once you see taxation and interest under your trade pay, under your current liabilities, it means that this is actually what? This is an outstanding, okay? An outstanding obligation. Now, I want to show you something small here. Now we have this tax, okay? And then we have what we call the finance costs. Just also to highlight to you that interest is also finance cost. Okay, interest is also finance costs, just so you know. Okay, and why they call it finance cost is because we are paying interest on the loans, okay, that they have given us to finance our business. So that's why it's called a finance cost. It's a cost that is associated to the finance that for our business. Okay, now when somebody says interest, there is also what we call interest income, and I don't want you to confuse these things. Okay, sometimes the examiner, even when it comes to other questions, they can bring you a trial balance and just put the word interest. Now yours is to know that interest income will always have a credit balance, and interest expense will always have a debit balance. Okay, so you don't need to confuse the two things. So this was our P&L. Okay, because this is our P&L. And P&L also has tax, okay, and also has finance costs. Now, the 41,250 that you're seeing here for finance costs are the finance costs for the year, okay, are the finance costs for the year. And the 18,000 you're seeing here is also the tax for the year, okay? But it doesn't mean that this is the tax that was paid, or it doesn't mean that they were actually the finance costs that were paid, okay? You need to distinguish these two things. And what I mean by this is that the P&L, the statement of P&L, we know very well that this records transactions on accrual basis, okay? And by accrual basis, I'm trying to mean that transactions are recorded not necessarily when cash has been, let's say, received or paid, but we rather record items, we record expenses when they have been incurred, and we record revenues when revenue has been earned. Even if it was not, either we have received cash or not, we actually record. So whatever you see under your P&L, this is the tax and the finance cost, which is your interest. Now, like I said, when you come to your statement of financial position, yours is to find out and see, do I have anything under my liabilities? So it means that despite you having the other figures in your P&L to represent either the finance cost or interest for the period, and then also taxes for the period, whatever you find in the current liabilities is the portion of those two things that have not been paid by their end. So they are remaining as liabilities, okay? They are remaining as liabilities. Now, once we come to our cash flow statement, what we only want to know is what is interest that was paid and taxes that was paid. We don't want to know the interest for the year,
Our tutor is off, and I think he's trying to fix the issue. He will come shortly. Keep revising what you have at hand. Thank you.
All right, sorry about that. I had challenges with my internet here. I just can't tell what exactly happened. I'm just trying to change this name so you don't confuse me with another person. Okay, so I was trying to still explain to you. Thanks for being patient and understanding. I was just trying to explain to you something when it comes to the cash flow statement, saying that, like I indicated, the cash flow statement records things that were paid and things that we received in terms of cash. It does not record things that are to do with just expenses in general. Okay, so I'm just trying to explain the different how all this differs. The interest that was paid and the taxes that was paid, how that basically differs with what we have within our P&L and within our statement of financial position. Okay, so you need to basically understand how those come into play. So for us to determine our taxation and interest that was paid, because this is the taxation and interest that was pending at the period. Okay, and remember, it's not only this, but we also have what we started with at the start of the year. When we were ending 2015, we also had 18,750, and then we also had 15,000. Okay, so we're able to draw what we actually have to do to determine the interest and taxation paid. We have to draw up accounts. Okay, we have to draw up what we call the tax payable accounts, or the taxation account, as well as our interest accounts. Okay, and I just want to show you. I know I'm not doing this systematically, but I'm doing this because, like you saw, I call this a revision class. Okay, so I make assumptions that you have some prior information, or you basically, I'm trying to help my friends that may just want to understand this. Okay, in a much simpler way. Okay, so what I want to show you is how we actually determine what we call the taxation paid, or the taxation paid, or the respective. Okay, right here. Okay, I'd lost this. So I was saying that this is basically, these are the I've shared with you the notes, just in case it pushes me out. You can be able to look in there, okay? Yeah, so just can't tell why, but let's try our best and see if maybe it stays a bit stable, okay? So I just wanted to share with you something small when it comes to interest and taxation, okay? And like I said, we have some values here. Then we also have some values in our statement of financial position. And remember what I said, that our question, okay, or what we have within our cash flow statement is actually, they want us to determine what was actually paid, okay? So I was just trying to draw up how you'll be able to draw up an accounts to represent that, okay? To be able to find that value. You may use even this information when you, remember when we did something on a single entry, okay? I think questions around there. So let me just do something on interest so you basically see how this plays, okay? So this is interest, this is interest, this is basically interest expense, okay? And it's the one that we are going to use to determine the interest that was paid. And yeah, to be able to take the other side. So interest expense, I want you to watch something small here. So this is the interest. So this, remember, this is for 20, this is what we ended with at 2016. And then this is what we basically started with. Now, interest, if it's an obligation, it's a liability, okay? It's a liability, and liabilities have a normal credit balance, okay? So this 15,000 of interest is your opening balance in that account that I've drawn up, just from your statement of financial position. As you can see, this is basically interest payable, okay? So this is interest that I'm going to record within my account right here. So I'll come here, since it's a balance brought down, I'll just come and say balance. I can even include the date. This was first that 2016, okay? And I have balance brought down. Now the balance brought down is of course 15K, okay? It's 15,000. This is 15,000. And then I'll record my balance. This on 31st 2016. My balance, the balance that I'll record is this balance, this 3,250, okay? This 3,250. So this is what I'll basically come and record here. I think you remember when we were trying to do a question on single entry questions, where we say that if the balance brought down is this side, then the balance carried down is on the opposite side, okay? And the reason why the opposite side is because as it is a balance carried down of this value at the year end, it will be a balance brought down in the next period on this other side,